Acting like we. Oh, I see 50. I see 50. All right. I'm not even going to look no more. I'm just going to go. You lucky sons of guns. Lucky I paid $100 for it. All righty. Here we go. All right. So, now that we have 50 people, I'm going to go over this Excel one more time just so people can kind of understand how options are and what they are. So this is an example of the S&P 500. I can't remember exactly how quickly this expires, but it's probably like a week or so. Anyways, the strike price was $323. And the basically, I want to know, like, I don't, if you're going to buy into an option, you need to be thinking about a stock symbol that you think is going to move a lot in one direction or the other. Because we don't short here. I don't teach, like, I'll teach you a little bit about, like, credit spreads, which is the only type of shorting I do, but we do not short stocks here because we believe stocks only go up, right? At least AMC and GME. So we don't short. So I'm only teaching how to buy. And so buying is more about like investing a small amount of your account and winning big when you win and not losing too much when you lose. But you lose more than you win. But when you win, it's worth it. And so I'm going to, when you know a stock symbol is probably going to move a lot, whether it's news, this, volume, whatever, you kind of want to look like you want to come to your information and you want to look at it like this. So say, do you think it's going to go up 1%, 2%, or 5%? And do the mathematical projection on all of them based off how much it costs. So let's take an example. If the market moves 1%, forget 50 viewers. I will help you get 1,000 subs so you can monetize your stream. I'm not worried about paying for subs. Like, I already seen a site that does that for me, and me and my crew agreed that we were not going, like, I'll do super chats all day just because I like talking shit on people's YouTube streams, but we do not do subs. Like, we're not paying for subs or account growth. But let me continue. So, if the stock moves up 1%, that means the $323 current strike price or stock price would have grown to $326.23. If we look at our strike of 324, the ask price is $2.70. Every option is 100 times it by 100. So now it's $270. So that $270 is now what our cost is. And because we grew $2.23 over our strike, we get $223. So we make 223, we spent 270, that means we get a net loss of $47. Well, had the stock price gone up 2%, it would be at like $329. And what it happens then is it says the best strike would have been the 325 strike because it made 104% ROI. So basically $219 grew to $227. Well, $270 only grew to $276. And $174 only grew to $172. But then I said, what about 5%? What if we go way out there? And if we go way out there, then it says the best strike is 336 strike. And if the stock price ends at 330, or sorry, 5% above 323. So if we go equals 323 times 1.05, we get 339.15. And so the 336 pays the most out of all the contracts. $8 contract grows to $307 by it growing to 339.15. So we bought the 336. It wasn't the 339 strike, even though it went to 339. And it wasn't the 324 strike, even though 324 is way less than 339. It was the 336 strike that turned $8 into $307. And so if we would have invested the same $276, but in multiple $8 contracts, we could have grown $270 to $10,438. So that's how general buying of options should, like, if you're, that's how you need to be thinking if you're buying options and you're holding to expiration. Like, you should be calculating like this, and you should have an expectation where you think the price is going to move, so you know exactly how much you expect to make in a profit. And then if the stock doesn't do what you want it to do, you can kind of get out, double down, do whatever it is you need to do. I don't know. All right, guys, on to the $1 billion. Here we go. Let me find it. Let me find it. You are lucky sons of bees. Lucky, lucky ducky. The best sell credit strategy. I think this. Oh no. All right, we're going to start with this. So to understand my strategy, before you can understand my strategy, you have to understand what the SPX is and what the SPY is. Now, the SPX is only options. There are no stocks of the SPX. It represents the S&P 500 and it represents the SPY, but it's 10 times larger than the SPY. The SPY also represents the S&P 500, but it is an ETF and allows you to purchase stock of the S&P 500. Okay, so let's actually Google a couple things real quick. Cross margin, SPY versus SPX. All right, so this is from the CBOE, the Options Institute. So like this is the real deal. This is big time stuff right here. And the only thing that I want to show to you on here is the cross margining. And so basically, all right, so depending on the account that you go to, in order to cross margin the SPY and the SPX, you have to, in order to cross margin the SPY and the SPX, you have to have a portfolio margin account. So what that means is, like, if you are on, everyone, like, let me take one step back, and I'm going to explain a credit spread real quick. So a credit spread buy, sell, select. So I'm going to come here. Let's just do one like out here. Okay, I'm going to come here. I'm going to buy at the 400. So at the ask price. And then on that same expiration, I'm going to come in here and I'm going to sell at the 399, which is the bid price. And I've created a leg that looks like this. And let's go ahead and make this a little bit smaller. So we'll do 380 to 420. And now we have something that looks like this. And basically, if the market goes up too much, above 400, then we lose $55. Anywhere below that, we make $45. We can only make $45 or lose $55. There's really no in between. Okay? So, Razel, you spam my chat and you get booted. So, calm down. I'm teaching people how to make $1 billion. You look retarded right now. And we don't need that in here. What stocks to buy today? Like, more garbage. Like, don't... I'm teaching you how to make $1 billion with options right now, and you're worried about stocks? Like, shut up. Think about what you're saying. All right. So, this is a credit spread. Now, I like to think of a credit spread a little bit more detailed than this, and I like to do a 4-leg credit spread. And so, what does that mean? I bet the top and I bet the bottom. So now I'm buying and I'm writing calls. So I'm going to come here. I'm going to come back to that same expiration. And I'm going to find that 400, and I'm going to buy at 400, and then I'm going to sell at 399. And then I'm going to come down here and oops, I already did that one. And then I'm going to come down here and I'm going to do the same thing, but this one I'm going to do for puts now. So I'm going to come here and I'm going to go to, let's just say 390, and I'm going to, this one I'm buying at the ask price for 572, actually we'll say 599. And then on this one, I'm going to come and I'm going to sell at the bid price for 624. And then I'm going to calculate, and then I'm going to update this to 390 and 410. Calculate one more time, and now you will be able to see what I'm trying to do. So basically I set up, here's the current stock price, right? And I set up a thing where if it goes up and down, up and down, up and down, and it falls anywhere in this range right here, I make $70. Then right here, it's 45 right there, -5. The most I can lose is $30 on one side and $30 on the other side. So I have created a call credit spread, a put credit spread on the same expiration of the same stock symbol. And so now it can only fall into one spot, right? Top or bottom. Why is your room such a mess if you are good with options? I'm a gambling addict, freaking Irish car bomb drinking at 6 in the morning, freaking dab smoking, marijuana token. Like, I'm a rebel child, bro. Like, what kind of stupid question is that? Why does my room got to be clean for me to be able to be super good with options? Like, that's the dumbest thing I've ever heard. Seriously, that ways to make $1 billion. Why don't hedge funds don't do it? Because hedge funds aren't as smart as me. Artard, I am literally here to tell the world that I know everything they don't and they wish they did. And I'm giving it to you for free and you can't even be patient enough for 30 minutes to listen? Like, think about yourself, man. You're crazy. All right, so check out this credit spread that I just showed you. This is incredible right here, right? Like $70 chance to win if it just moves sideways, or if it goes real up and then comes down by the end of it. Like, you got a coin flip of landing in this. Historically speaking, the price is always somewhere where it used to be most of the time, but there are lots of periods where there's big spikes. And so a big spike happens, you lose $30, but when you win 70. Like, we're talking money in the bank. So this is how I want you to understand my strategy. But remember, this is only the SPY. I haven't showed you the SPY versus the SPX yet. But now you have a good idea of how my strategy works. Big picture. So now we're going to go to... We just did the credit spread. So now we're going to go back to... What was I going over? Oh, yes, my Excel. So now we're going to go over the SPY versus the SPX. So right here... What I have is I have just the stock prices, okay? This is only stock prices. It's the open, the high, the low, and the close of the SPX and the SPY. And it's every market day for the last, let's just say 8 years, okay? Every market day for the last 8 years, SPY, SPX, as it grew from all the way from 100 to 3,000. I will show you my portfolio later, Razil. But right now, I'm showing you how to make $1 billion. Everyone else in this chat has already seen my portfolio, so calm down. I did not input this into an Excel. I had to pay $30,000 to an actuary that I hired from an actuary recruiting firm in Chicago. And I basically had to tell them what I wanted done. And it's been 6 months of just slowly them barely being able to understand what I want and slowly giving me what I need. So, to answer your question, I did not do this. Somebody else did it for me. But that's not exactly important. You can see the data just fine here. And I can always post this data somewhere if anybody needs access to it to validate or whatever. Okay? So, what we're going to look at for here is the price difference between the SPX and the SPY close, okay? And how it relates. So SPX does not have stock, remember? Which also means they do not have a dividend. SPY does have a dividend. And because it has a dividend, it creates a consistency of stock price comparison to the SPX that we can rely on for our trading and prediction of where the prices are going to close, not whether they're going to close up or down, but where the prices are going to close in relation to each other. And because we know where they're going to close in between each other, 30 days before, we can analyze credit spread opportunities where the greatest amount of credit spread on both the call and the put side is larger than the possible variance of the risk that it could go up or down either side based on where we know it's going to expire between the price differences of the SPX and the SPY. So check this out. I've labeled in here, wherever the X's are is where a dividend day is. And so where these zeros are is where a dividend day is. And what that means is, if you look, if if it's positive, it means the SPX is greater. If it's negative, that means the SPY closed greater. So if you look, the day before dividend, the SPY was greater. The day of dividend, the SPX is greater. And every day after that, the SPX is greater. And it slowly works its way down all the way until the SPY becomes greater again. And then it looks like I'm missing one. If I had one more day, I could show you how on the next dividend day, it shoots right back up. But let's just go ahead and look at these other dividend days. So we're going to look at like the last 4 dividend days so you guys can see that the dividend and the price between the two work the same consistently throughout, and it's something that you can rely on and accurately bet on. So here you'll see that the SPY was greater by many, many dollars, right? Not just $1. But then at dividend day, the SPX becomes larger, and the SPX becomes larger, and then it's smaller and smaller and smaller and smaller. Then the SPY is larger. Then we hit another dividend day. And all of a sudden, look, the SPX is larger by $10. And then slowly it works its way down. And then boom, we hit another dividend day. And you guys can, like, do I got to make that any more obvious to you that this is a consistent, repeatable pattern? Every dividend, the SPY becomes smaller than the SPX again. And as it comes closer to dividend, it works its back way up to being closer to the SPX. My Discord invite is expired, invalid. I don't know why. Okay, you must be like mentally retarded if you haven't seen enough value already. You must be truly mentally retarded. Like, I feel bad for you, Kay. I really do. Let's see. Thank you for showing us how to do this. How did you discover what you have the actuary create for you doing this the past 6 months? So I actually got into options 2 years ago with $500,000. I lost it all in about 6 months over doing 2,000 trades with the SPY. And after I lost all that money, I've learned a lot about options and stocks and how everything moves and what the potential is and all this stuff. And so I spent the next year and a half just like, I put myself on house arrest and I said, I'm going to learn everything there is to know about options. And basically I found multiple opportunities, and this was the most guaranteed, like $200,000 to $1 billion. This is it. I'm showing it to you right now. And so if you watch this, you'll know how to make $1 billion. And all you gotta do is get your hands on like 200 grand to turn it into an algo, and then 120. Like, it'll take like 50 grand to pay an actuary to turn it into an algo, probably, if you have a really good one, a good actuary. And then it would take probably. It takes about 125 grand to start a portfolio margin account, and that's all you need. And once you have those two things, you just turn it on and it starts making the money. How did I get 500K to start? So I started a roofing company. Well, before that, I started when I was 23 years old. I got into life insurance. I like revolutionized the whole thing. I built the product. I never really made money off of it, but my brother had a lot of success and he's making a lot of money off of it. And I wanted to get out of the roofing industry, so I sold my shares of my 50% of the company with my younger brother, my other brother, who's a younger brother. And between selling him my shares and then like I started making money right away when I got into the options, just doing early to expire SPY, SPX, at the money options right before market close and at market open, like just with a big swing either direction of 0.5%. I'd make like 100% on my money that I invested, and I invest like 10 to 25% at a time. But the first time that I invested, I turned 15,000 into 85,000, and then like some of the money was mine from selling the company. My brother with the life insurance, he sent me $200,000. But I mean, he's made 10 million, so it's not like he would like. He wasn't hurting. It wasn't like he was betting the farm on me or nothing. It was like he didn't want to miss the train because he thought I was about to make a lot of money because he's already seen what I can do with my research. And so I ended up losing it all, which was a bummer. But like, if I didn't lose it all, if I didn't have that much experience into it with that much on the line, I wouldn't have learned so much, and I wouldn't have been able to take it on for another year and a half to get the answers that I have now. So, how much do you need to play the June 40 strike? You don't need more than $100. I think it's $100 right now per contract. So we'll get the Discord updated. I don't know. Let me try to do that right now real quick. No, the life insurance product that I have is more of a retirement plan than a life insurance product, and it's why am I teaching you for free? Is it out of goodwill? It's kind of out of goodwill, but more so, I am hoping that you will appreciate the information so much and trust that I'm being so open and honest that like you realize I don't have any ulterior motives to this, and that ultimately you end up investing in the same strategy that I'm investing in. And when I go, and so basically I'm buying a lot of these options, and if you buy these options with me, you're going to make money when I make money, and I plan to make a lot of money because it was just February 24th and 25th when GME popped 150%. I turned 10,000 into $1 million in options, and I'm about to do even more than that with the AMC option. And the best option is the June 40 strike, June expiration AMC $40 strike. And I think everyone should buy as much as they can. And if you do buy those, then when we do profit together, and when I sell, you sell, then what I'm going to do is I'm going to take half my money. I'm going to make sure I take care of my taxes, debts, all my family, all these other things, because I plan to make $100 million, right? Like, and then I'm going to take my other 50 million and I'm going to put 25 million in AMC and 25 million in GMC stock. And you guys are going to do that with me with your percentages. And then with all of our money together at the exact same time, when we buy the stock, we are going to, like, there's lots of limit orders right now for $10,000 a share, $60,000 a share. When we put in all these limit orders at that same time, it's going to buy everything that's available on the market order books. And if we buy orders at the $60,000 share, like, those are going to be the last ones to fill. But when it fills, it's going to raise the price that high. We will force the price that high. And when it goes that high, it will force everyone to join us, and it will be that catalyst event that forces the market to finally finish falling and the GME and AMC to rise forever in all of its glory. And then we will bring God's future to this earth, and it will be beautiful and great, and everyone can be very, very happy. Can I get a life insurance minimum? Why are you teaching this for free? So I hope that tells you why I'm teaching for free. Let's keep going, guys. Let's keep going. So I've shown you how the consistency works inside of the quarters. But if you look at this, so in this last 10 days of to dividend, so we know this is dividend day. We know the SPX is going to be larger than the SPY on dividend day. But in all the days before that, we thought the SPY was going to be larger than the SPX. So if you look, it's not a perfect system where sometimes the SPX is $17 larger here than the SPY. So we would have lost a decent amount of money on this one. But when it's negative $12 here, when we made our bet, we would have made bonus money on all the negative $12. So as long as we are spreading our risk out throughout like a rolling 30 days of expiration days or whatever, or 10 days of expiration days, and we only put like 5% of our account balance in each day, then we can never lose too much per day. But also, as long as we win 9 out of 10 times, then the 9 out of 10 times we're going to be making literally 1,000 to 10,000% ROI per year. Will the SEC interfere? It is possible this could get shut down someday. I really don't think so, though, because the whole market is a free market. Like, you don't understand how liquid the SPY, SPX options are. There's more volume in these options than any options in the entire stock market, and they can't stop me from buying and selling these options, right? And so I don't think necessarily the SEC will shut it down, but I do think that because I'm sharing this with the whole world, I think I could have taken this and I could have made $1 billion before anyone knew about it. But now that everyone knows about it, like the first 100 people to do it will probably end up making billions of dollars, but then like eventually the liquidity is probably going to get tapped, and the variance is probably going to get even closer and closer and closer, and it's probably going to price itself out to where, like, unless you're just like speed trading it, I don't know exactly how it's going to work, but I would imagine that the liquidity on these are going to be sold out or something. Like you're only going to be able to do so many contracts per month, and so that will mean only so many people can get in, which will mean, yeah, I don't know. We'll see. But again, I don't really care because we got AMC and GME, and AMC and GME are the same to me. They're the same thing. They're both going to the moon. They're both going to be when the market crashes and nothing has any value, AMC and GME will have value, because when we invested, we thought we were going to win a lot of money, and it was going up and it was going up. And then January happened and GME was happening, and I wasn't in for all this. And then all of a sudden they all jumped into AMC on January 27th. And the day before January 27th, on January 26th, GME went up 150%. And then on January 26th, GME went up 250%, and AMC went up 150%. And that's when Robinhood only allowed selling and didn't allow buying. And that's when the prices crashed Thursday at the close, and all of Friday and all of Monday and all of Tuesday, and just on and on and on. And it's been a battle. And every time it crashed, we just bought more and more and more. And they made it cheaper for us and cheaper for us. And all of a sudden, no matter how hard they tried, when they tried to crash the price, it kept bouncing back, and they couldn't crash it. Not in one day. Like, no matter what happens, we always basically break even on our worst days. And we're upset about breaking even now because they can't crash it anymore because we bought the dip too much. And so GME and AMC both fall under that category. They're both going to make a lot of money. But don't even worry about that right now, because we're talking about the options. And when we're talking about the options, we're talking about AMC options mostly. And when you buy those options, after AMC hits $100 a share, everyone else is waiting for AMC to hit $2,000 a share. I'm showing you how to take AMC at $100 a share to make $1 billion, and then throw all that into the stock. And when you throw it all in the stock, then we turn the stock into an invaluable commodity where everyone else has to join us because we forced the catalyst to happen. You lost me with this God stuff, I think. Then you need to go, bro, because God is real, and God chose me, and I worked for this, and I deserve it, and God is blessing me with all the glory of this world, and I think you need to go. I'm going to be who I am nonstop all the time. If you don't like it, then just get out. So now that you understand that, what I had him do was I had him create a little formula. And basically, I told him I want to see a formula that tells me like the averages of the stock price of the days to dividend. So on dividend day, the average price was the SPX was $10 larger than the SPY. The day before dividend, the average price was the SPY was $3 larger than the SPX, and so forth. So like 20 days before dividend, basically a break even, right? Or like the 1817 day is when the SPX and the SPY are expected to be the same price. And so basically, with this information, let's go ahead and find out where we stand in that right now. And so actually, I know where we stand in that because the last dividend was on March 15th. Okay? So what's your AMC spread? I don't have a spread on AMC. I'm not doing credit spreads or anything. On AMC, the only thing that I'm buying from now on are June expiration $40 strike calls. And I'm going to buy as many as I can. From now on, any dollar I ever get, that's the only thing I ever buy until it pays me hundreds of millions of dollars. Okay, I don't know about BLSP, but I'm going to finish this $1 billion strategy like we were talking about. Like, I don't know why you're trying to change the conversation. We are talking about how to make $1 billion. So, now that I have something like this, now there's a much better way to make this formula. So you're going to have to go have an actuary take this data and find the perfect way to estimate what the closing price is going to be for the days that you're trading on. And what you're going to see is that every other day basically is going to have an expiration day. So that's going to be an expiration day. 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 And so forth. And so whenever you're going to, anytime there's an expiration day where the SPY and the SPX have the same expiration day, and it's not an AM option, then you're going to want to find the average dollar difference. And with the average dollar difference, am I a millionaire? I am not a millionaire. I've made millions of dollars. I built a roofing company. We did $20 million in revenue. I've never really had more than $50,000 in my account throughout making all that money because I love to go on vacation. I love to spend my money. All that good stuff. And then the most I've ever had in my bank account at that time was 500 grand at one time. But then after this GME AMC thing happened, I got into GME and AMC February 1st. The February 24th and the February 25th pop happened of 150%. And when that pop happened, I turned $10,000 worth of options into $1 million. I cashed out 500 grand. And since then, I've lost the other 700,000 and more options. And I'll go over my account balance and all the trades that I've made in the past soon, after I go over the $1 billion opportunity. And then also I still have like $300,000 of profit outside of the market, but I just brought in $100,000 on Monday, because I lost the rest of it that I had in my account, and I YOLO'd that $100,000 mostly into April 16th $800 strikes for GME, and June AMC $40 strikes, for AMC. Yeah. This neek is ramping for real. Dr. James, what is a neek and what is ramping? I hope that's a compliment and not an insult. I'm not into options. Could someone achieve similar results just by buying AMC and selling high? So yes, AMC will go to $1 million a share. Like, I'm personally going to hold on to some AMC and some GME for the rest of my life, because I believe in the end it will be the only thing worth money. Now, when I make $100 million, I'm going to take 50 million of that and I'm going to help my family get rid of their debt and like retire. And I'm going to make sure I do the same. And then also I'm going to take that other 50 million and I'm going to go buy AMC and GME stock, because it's going to be worth $1 million a share. And so, yes, you can just buy stock. You don't have to buy options, but I'm encouraging you to apply for a level 2 options account, which is very simple. It takes 10 minutes, and then go buy some of those AMC June expirations and just watch my live stream every market day. When we make money, sell when I sell, and then just follow my plan. I got the plan. So, Mock is laughing, thinking this is funny. He must not have been watching, because I'm spitting facts and truth here. So now we understand we want to analyze an SPY and an SPX matching expiration day. And then we want to find out what we think that day is going to close price difference between the SPX and the SPY. And is the SPX going to be larger, or is the SPY going to be larger? Because it's very important. Now, what are we going to do with that information is the next magic $1 million question that I'm about to answer. So, right now, where we stand is somewhere around here. The dividend just happened. So we can expect, let's just say we can expect a $10 price difference between the SPY and the SPX today. So actually, it'll probably be even more than that, just because the price has gone so high. So let me see let's see, is my account still open? Let's go here. Oh, if anyone wanted to see my account portfolio, here it is. So GME and AMC are 95% of my account, and it's all of these guys right here. So I do, like, there you go. There's the facts. If I scroll a little bit over here, you can see my market value. So I got 43,500 in AMC June options. I got 12,000 in the 14 contracts of April 21 GME options. Or it's April 16th, 2021. So that's where the majority of my money is. Obviously, I came in with 100,000 on Monday, so I've lost 40,000, but I ain't sweating it, because I know that this April and this June options are paying me millions and millions of dollars. With that said, let's go to SPY and stay logged in, fool. I just came here. What are you talking about? Get out of here. All right. Trade. SPY. Is at 395.1. SPX is at 3953.5. So we had 395.1 and then 3953.3. So at the same time, these were the two prices. Well, if we times the SPY by 10 to make them equatable, we got 3951 and 3953. Let's make sure that I got the SPY one accurate. It's 395.1. Perfect. Okay, and then let's Google something real quick, because I thought one thing, but maybe I'm wrong. SPY dividend date. Oh, my bad. So we expect the SPY to actually close slightly above the SPX today and tomorrow. And then on the 20th of the next dividend date, that's when we know that the SPY is going to be roughly $14 lower than the SPX. So that was my bad, but now you guys know. So what I'm going to do is I'm going to come to optionsprofitcalculator.com now. And I'm actually going to need 2 of these. So I'm going to get price. I'm going to SPX. Now, the numbers might come out a little weird because optionsprofitcalculator.com doesn't always do a great job while the market is still open. But we're going to give it a try. And if I have to do this again when the market closes, I will. All right, we got 3960 and 395.87. So they should be pretty close to each other of what they're doing right now in the current market. So what I'm going to do is I'm going to go to select option. I know that on the 22nd, that is after the dividend day, that the SPX is going to be much larger than the SPY. So let's just take an example right now and say what happens if I'm going to take the bid and the ask price of the we'll do 397 strike, okay? So it's going to be 98 cents and 97 cents. So we got the 22nd expiration. Ask price is 97 cents, so 0.97. The bid price is 0.96. And the strike is, what was the strike? The strike was 397. 397. Now, I'm going to go grab the SPY one, or the SPX one, and I'm going to select option. I'm going to go to the 22nd. I'm going to go to the call of 3970 because we use the 10x multiplier to compare them, and I get 1450 and 1480. So now I got 1450 and 1480. So I got 1450, 1480, bid, ask, strike is 3970. Now I'm going to times these by 10 so that I can see them as a comparison of the 10 times multiplier. Because every time I do an SPY contract, I do 10 SPY contracts to every 1 SPX contract. That's why I do a multiplier of 10. Hang on. All right. So what this means is I can come here and I can, at the same strikes, I could sell for $14.50 and I could buy for $9.70. So if I take $14.50 and I subtract $9.70, my credit spread becomes $4.80. So now it's $480, right? Well, if I do it on the put side too, let's say it's usually a little bit smaller on the put side. So let's say I get 300 on the put side, right? So let's say I'm at a total of 780 for my both the put credit spread and the call credit spread to create that opposite. Someone call it the opposite of an iron condor. Sure, maybe that's right. I don't really know the names. Like I can see a strategy and know what it does, but I didn't really learn all the names and everything. So if I have a $780 credit spread, what this is saying is because I sold the SPX and I bought the SPY, let's assume that they both go in the money. Well, basically, the price difference between the SPX and the SPY is my maximum risk. And because I sold the SPX for the 1450 and I bought the SPY for the 9, or I bought the SPY for the 970, that means if they both go in the money, but the SPX goes higher than the SPY, which we know it's going to because the dividend's going to bring the SPY down. So the dividend's going to bring the SPY down, and the SPX is going to be probably $10 higher, right? So that means if it expires in the money, then we collect 780, but we could lose potentially $1,000 because the SPX closed $1,000 higher. So that's kind of an idea of how to look at one example of my possible strategy, right? That one, I would argue, is not a very good one because we want to have next to no risk. And so the idea is that there are certain times where and you basically just got to get an actuary to be able to track the pricing and say, we know it's going to close, we know these expiration days are going to close at these prices, and I'm going to scan the SPX, SPY credit spreads from 30 days all the way until they expire. And when there's a good price difference because when the SPY becomes $10 less than the SPX, it moves all of the option prices. And so as the SPX and the SPY move away from each other and then move back to each other throughout the 30-day period, you can plan in advance where you know the prices are going to expire, and you can basically find the correct spreads where maybe because I know that they're going to expire $10 apart from each other, rather than doing the 397 and 397.0, what if instead I buy at the 395? Well, let me think about this. So, like, there's a lot. So sometimes I gotta take it a little slow. Or no, sorry, it'd be 396 if I want $10 difference. So if I buy at the 396 instead, let's see what that looks like. Oh no, I don't need that. I need, where was I? Oh, I do need that actually. My bad. All right. So if at 396, so if it was at 396, then what if I sold that and then bought at the 398? So 398 would be $10. And so what this is basically telling me, because I haven't really looked at a 3-day one in a long time, but at the 3-day to expiration, March 22nd, there just really isn't an opportunity. But basically the idea is that because I know that the SPY is going to be $10 lower than the SPX, then what I'm going to do is I'm going to come in here and I'm going to buy, or no, I'm going to sell at something like 396, but then I'm going to come in, I'm going to buy at something like 397 for the SPX, and basically make it to where I'm accounting for that $10 price difference. I'm expecting the SPX, so you can assume that the price difference is going to happen and then look for the different strikes of that much price difference and find out when that credit spread is still going to make you the most money. And again, if you have a regular account, you can't trade this cross margin. And you really can't trade it at all because then it ends up assuming that you're naked selling the SPX. And so the only way to possibly trade this is with the portfolio margin account, which requires $125,000 minimum investment. So let's go ahead and look at a better example now that we have a slight understanding of how it works. So let's go further out where we think, like, this is still going to probably be about $10 out of the money difference. And so if I come here, which one are we on? We are on the 5th of April. So I'm going to do the 5th of April on this one as well. They don't always match, and so you got to make sure they both have the same expiration date because they don't always do. Okay, now on this one, what I want to do is I want to come in. I know that the SPX is going to close about $10 higher on this day because the first 30 days after dividend, it's always about $10. But again, your actuary will have to perfect that number. And so I'm going to either sell at 396 for the SPY and then buy at 397 for the 3970 for the SPX, or I'm going to sell. Well, let's see how that looks. So we got 412 we could sell it for, which is 4120 if we times it by 10. So 4120 at 396 we can sell it for. At 397 we could buy for 4270. So 4120, 4270. So you'd see right there that that one actually cost us $1.50. So rather than having a positive arbitrage, it is a negative arbitrage of $1.50. And so I haven't looked at this in a minute, and the prices have been moving so much. So what I'll do is I'll go through and I'll find one perfect example when the market closes and the prices aren't moving, because when the market's open, these prices just probably aren't accurate right now. But once the market closes, like, you'll see that the same prices that it says on E-Trade will be the same prices you see here. But if you look at these same prices, if you try to Google them on your E-Trade account or whatever, you're going to see different prices. And so I think that's the problem that we're having. So when the market closes, we'll go over this again probably tomorrow, because I got to leave right when the market closes today. But yeah, I mean, I literally just told you everything you need to know to make $1 billion. If you don't feel that way, you just don't know enough about options, I guess. And credit spreads, like, credit spreads are guaranteed. You know exactly where they're going to go. And so rather than the credit spread being the difference of the two strikes of what you bought and sold at in a traditional one stock symbol, because you're cross-margining two stock symbols, the credit spread, the max risk, instead of being the two strike difference, becomes the difference between the close of the SPX and the SPY, which we can calculate and prepare in advance for, because we know exactly how the dividend makes the SPY compare the close price to the SPX. Is anyone impressed by that? Please tell me you guys are impressed by that, because that is like the most impressive stock option information ever, and nobody knows about it but me. This is the first time you guys have ever heard about it. I guarantee it, because I've been calling and freaking putting people on blast, and everyone acts like I'm crazy, but the math is factual, and I've already proven it, and I know I'm right. So you're never gonna make me doubt myself. That's for sure.